Hello, welcome to the Economic View again. I'm here with Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, good. Evan, I wanted to talk to you really about lending finance stats which came out from the Australian Bureau of Statistics. Also what's happening in the housing market generally, and then we can really sort of gravitate towards what's happening in the US this week. They're all linked together.
They're all linked together. Again, what we spoke about last week is whether or not you've got a glass half full or glass half empty view of the Australian economy or even the world at the moment. So, as you alluded to, the lending data is as you would expect. We know things are slowing down. So you've seen that, and answer the middle part of your question. We know Sydney and Melbourne at the moment are having a fairly reasonable slowdown. It is partly cyclical. This time of year tends to see a slowdown in clearances anyway. But over the last 2 weekends, it has been the slowest clearance rate since something like 6-7 years. So that is happening. That is fine. Yeah. I want to show you the chart that's on screen now, and that's coming out of Goldman Sachs. It's the best way to view this is that the overall figure is declining, we know that, but the majority of that is coming down from investor loans, and that should be seen. So we know macroprudential rules have been now in play for probably 24 months. We have seen out-of-cycle rate rises, and that'll come to the second part of your question in a minute, starting to impact investor loans particularly because they've now jumped right up there in the high fours. Some of them even I've seen as high as 5%. So that is certainly impacting yields. Owner-occupier is also starting to just decline. Not much, it's still expanding. The other thing to sort of put the caveat into it as well is that if you actually have a look at loan growth and the actual size of lending, it's still pretty robust. So yes, it was lower, but it's not the end of the world, and I think it's actually healthy.
It's to be expected. I mean, there's been various changes by APRA in terms of, what the banks can do, particularly on interest-only loans.
Yeah, and I think the Banking Royal Commission needs to be put in there as well. The banks are clearly getting ahead of the curve before whatever hand-down comes, that you can see they're already changing their lending. And that, again, is probably prudent, considering that we know, the peak of the bubble that everybody was explaining to in the Australian housing market probably was end of 2016, diffused through 2017, and we're now slowing down.
Evan, out-of-cycle rises, there's been a lot of them going on. We did a story on it recently. There was more than 400 out-of-cycle rises so far this year alone. And it's a very competitive space, obviously, as the banks and other lenders are moving their rates around. A lot of that has been going on in the investor space, though, and on interest-only loans, admittedly. Some of it's flowing through to owner-occupied loans as well.
Yeah, it is. And I picked that up on that. The way I look at that, so the piece obviously really clearly shows that it is across the board. So it's not just investor loans, as I alluded to. It is across the board. They have targeted, as you said, interest only. From my perspective, it's more around your original question was around what happens over in the States, and I will be doing a special on the Fed, so please keep an eye out for that. But they are now on track to not only raise rates 3 times in 2018, it looks like 4. We've already seen out-of-cycle rate rises from the banks off the back of the funding markets increasing. So what I mean by that is that 2/3 roughly of banks' funding comes from retail, and that's good. It's sticky money, it's simple, and it's quite cheap. But the rest of their lending book needs to be topped up by the wholesale market, and that's what you've been seeing impacting their overall margins. You've heard particularly ANZ and also NAB actually physically say that if everything remained the same as it had in May, and it has, they would probably have to think about raising rates because it would start to eat into margins, and now you're going to see rates move further higher. So if they are going to raise rates 4 times and possibly 3 times next year as well, that's another 7 rate rises. That's another 6 rate rises from where we currently sit. And that in itself would mean that US rates would be sitting more along the lines of around about 2.75% to 3%. And that's going to hurt us because we've already seen that the funding markets here in Australia reacted to that, and they should because we are connected to the global economy. That would therefore probably see the banks react, and that would therefore slow the housing market down faster still, and we put a bit of a squeeze even further in the credit market.
Yeah, there's going to be quite a big gap between the Fed and the Reserve Bank.
Yeah, and if all things remain equal, and what the Federal Reserve is telling you, what the RBA is telling you, the RBA doesn't look like raising rates till at the earliest probably the last month of next year, so November, December next year. So maybe it's at 1.75%. But if all things remain equal by the end of December next year, the Fed could be 2% higher than the RBA, something that hasn't happened basically in history, where the RBA is that much lower than the Fed. And there's even articles going around at the moment that the RBA could cut rates. Now, I don't see that because the reason for it is that inflation is their number one mandate, and inflation hasn't been reached since the third quarter of 2015. So a lot to talk about on the rates front, but at the moment, lending's looking quite interesting and is slowing down.
Well, we'll keep an eye on what happens this Thursday.
Thanks, Tony.
Thanks, Evan. Thanks for joining us on The Economic View.